The Federal Reserve's battle against inflation has defined the economic landscape of the past few years. From policy shifts to market impacts, understanding the Fed's decisions and their consequences is crucial for navigating these turbulent times. In this video, we will delve into the following crucial questions. What key events have led to the current economic landscape? How is the Federal Reserve responding to manage inflation? Could we see rate cuts as early as September 2024? What are the odds of a 1 basis point rate cut? What potential impact would such a cut have on the economy? Join us as we analyze these pressing issues and explore their implications for the future. The COVID-19 pandemic disrupted global economies, leading to an unprecedented rise in inflation. By mid-2021, inflation rates began climbing sharply, driven by supply chain disruptions, labor shortages, and significant fiscal stimulus. The Consumer Price Index, a key measure of inflation, soared to over 7% by the end of 2021, the highest in nearly 40 years. In response, the Federal Reserve shifted its policy stance in early 2022. Recognizing the persistent inflationary pressures, the Fed started raising interest rates in March 2022. This marked the beginning of the most aggressive rate hike cycle since the early 1980s. By December 2022, the federal funds rate had increased by 4.25 percentage points, aiming to cool down the overheated economy. The labor market, a critical component of the Fed's dual mandate, experienced significant fluctuations. Initially, job growth was robust as the economy rebounded from the pandemic-induced recession. However, higher interest rates began to temper job creation. By mid-2023, the unemployment rate had slightly increased from its pandemic low of 3.5% to around 3.8%, reflecting the Fed's delicate balance between controlling inflation and maintaining employment. Housing market effects. Higher interest rates directly impacted the housing market. Mortgage rates, closely tied to the Fed's rate decisions, surged, leading to a slowdown in home sales and construction. By late 2022, the average 30-year fixed mortgage rate had more than doubled from the previous year, resulting in decreased housing affordability and cooling the previously red-hot real estate market. Home prices, which had seen record increases, began to stabilize and even decline in some areas. The stock market responded dramatically to the Fed's actions. Initially buoyed by low rates and fiscal stimulus, equities faced increased volatility as interest rates rose. The S&P 500, which saw substantial gains in 2021, experienced significant corrections in 2022 and 2023. Higher borrowing costs and fears of a potential recession led investors to reassess valuations, resulting in a more cautious market environment. The Fed's strategy and adjustments. Throughout 2022 and 2023, the Fed maintained a data-dependent approach, adjusting its policy based on economic indicators. Jerome Powell, the Fed chair, emphasized the importance of bringing inflation down to the 2% target while avoiding a severe economic downturn. The Fed's strategy included not only rate hikes, but also quantitative tightening, reducing the Fed's balance sheet by selling off securities to decrease money supply. By mid-2023, inflation showed signs of moderation. The Consumer Price Index, or CPI, had gradually declined to around 4%. This was still above the Federal Reserve's target, but it did indicate that the aggressive monetary policy was having an effect. However, the economy faced mixed signals. While inflation cooled, growth slowed, and fears of a recession lingered. The housing market remained subdued and job growth was more tepid. Looking ahead to 2024, the Federal Reserve has not yet announced any plans to cut interest rates this year. In fact, as of their latest meeting in June 2024, they have indicated that they are likely to keep rates steady for the remainder of the year and potentially into 2025. The Fed is closely monitoring economic data, especially inflation, to determine when it might be appropriate to begin lowering rates again. While some economists and market analysts believe that a rate cut could happen later in 2024 if economic conditions weaken, the Fed has not committed to any specific timeline or amount of rate cuts. Their primary focus remains on bringing inflation back down to their target level of 2% and maintaining stable economic growth. It is important to keep in mind that the Fed's plans can change depending on the evolving economic landscape. Therefore, it is crucial to stay informed about the latest news and announcements from the Fed and consult with a financial advisor for personalized guidance on how potential rate changes could affect your financial situation. Despite this, some traders foresee a rate cut in September 2024. The challenge for the Fed is to balance inflation control with the risk of triggering a recession. Higher interest rates can slow economic growth, potentially leading to higher unemployment. The Fed's delicate act involves monitoring a broad range of economic indicators to navigate these dual threats effectively. As we move further into 2024, the Fed's actions will be crucial in shaping the economic landscape. Potential future steps include further rate hikes if inflation remains stubbornly high, or rate cuts if economic conditions worsen. The Fed's ability to navigate this challenging environment will be crucial in determining the broader economic trajectory. The Fed's battle against inflation has shaped the economy over the past few years, influencing everything from job markets to housing and stocks. By understanding these dynamics and the potential for future rate cuts in 2024, we can better anticipate and adapt to future economic developments. The information provided in this video is for educational and informational purposes only and does not constitute financial advice. Please subscribe if you enjoyed this content. Thanks for watching. See you in next video.